Good evening, ladies and gentlemen, and welcome to our webinar on technical analysis. This is Barry Norman, and tonight's class is sponsored by CMSTrader.com, one of the world's leading CFD and Forex providers. Now, CMS.com or CMS Trader is sponsoring tonight's class. And also, if you go right now to www.cmstrader.com, you can open a demo account and follow along. There's no credit cards required, no deposit required, and you can see how to use their chart and technical analysis on their platform. So you simply go to www.cmstrader.com. Click on the buy or the sell button. It'll ask you to pick insert your email address and pick a password, and you'll have a demo account just that fast. Now, CMS Trader is a great place to trade. They are a regulated provider. They provide a great deal of education, impeccable service. They have many different types of trading accounts. They give you free signals. They give free market updates and free technical analysis. Now, talking about technical analysis, that's what we're here to learn about a little bit tonight, because some people want to make it extremely complicated. Some people get scared away by it, and others use it all the time. Now, technical analysis is a method of evaluating securities by analyzing statistics generated by market activity. A technician looks to take the emotion out of investing by applying rules that usually apply to almost every investment that fluctuates in the free market. Now, there are two basic schools of analysis. We have technical analysis and fundamental analysis. Now, there are lots of traders who trade by the seat of their pants by using fundamental analysis. Fundamental analysis is the news, the headlines, press releases, stock reports, earnings reports. But the fact is, if you read what happened with Tim Cook and Apple today, and that they're going to bring $250 billion back to the U.S. and pay $38 billion in taxes, and they're going to use that money to develop new jobs in the U.S., well, that was good for the stock. It was good for the Americans. But how would you use that piece of information to determine how high the stock will go, or if the stock will go up, how far it will go up? If you're going to buy it, what point should you think about buying it? And if you're going to sell it or take a profit on it, what point would you want to take that profit on? Where would you want to say, uh-oh, I'm wrong, and get out of the market? Because you'll never get that from fundamental analysis. Because you only get that by evaluating prices and price action on charts. And that comes from technical analysis. Now, despite all of its fancy and exotic tools it employs, technical analysis really just studies supply and demand in the market in an attempt to determine what direction or trend will continue in the future. In other words, technical analysis attempts to understand the emotions in the market by studying the market itself as opposed to its individual components. If you understand the benefits and limitations of technical analysis, it can give you a new set of tools and skills that will enable you to be a better trader. Now, the thing is, technical analysis starts out very simply. It starts out with a chart. Okay? And from charts, we then go to some very simple, fundamental things that make up technical analysis. And these can be trend lines, volume, and support and resistance. And these three things are simple things that one can put on their charts very easily and master the concepts in about a couple hours. And you don't have to go any farther than this. You can then use the fundamental analysis, but you have to be able to look at your charts and read your charts to determine where to enter the market, where to exit the market, what the volatility of the market is, because it only shows that price action on a chart. You're not going to see it in a news report. Then we want to determine what the overall trend of the marketplace is. Which direction is an asset headed? So when analyzing trends, it's important that the chart is constructed to best reflect the type of trend being analyzed. To help identify long-term trends, weekly or daily charts are used. Daily data charts are best used when analyzing both intermediate and short-term trends. And then we learn, once we've seen a trend, we learn to put a trend line on a chart. And this is where people get confused. Technical analysis basically is anything involving a chart. So when you hear people refer to themselves as chartists, they're technical analysts. Because it's not all those indicators and oscillators. It's not all that complex stuff like RSI and stochastics and MACD. Those are a field of technical analysis. But the basic building blocks of technical analysis is anything that happens on a chart. So price patterns, trend patterns, things like head and shoulders, pennants, flags, or using Japanese candlesticks on a chart is actually the field of technical analysis. So once we've learned how to use and read a chart, a simple chart, we then can start putting some lines on this chart. And this will start us on the world of technical analysis. The first line anybody needs to put on a chart is a trend line. A trend line is a simple charting technique that adds a line to a chart to represent the trend in the market. Now, drawing a trend line is simple as drawing a straight line that follows a general trend. These lines are used to clearly show the trend and are also used for identification of trend reversals. Now, that does oversimplify it then, doesn't it? It says, you're saying anybody can draw a line on a chart. Well, a trend line has rules. So let's go over to a live chart. Let's talk about what these rules are. Okay, so here is a current chart of the euro US dollar. I've got the current trend line drawn on here in blue. Now, a trend line has rules because the whole idea behind a trend line, we can see the trend of the asset here. Let me take off some of the stuff and clean up the chart. Okay, we can see that the price is moving in an uptrend. Okay, that's clearly obvious. But now we want to define this trend. And we do this by drawing a trend line. And this trend line is your first piece of information that you're putting on a chart, and it's actually called technical analysis. A trend line requires you to draw a straight line between two swing lows in an uptrend that can be connected together with a line that hasn't been violated by any price action, but is not valid until it has a third touch. So in other words, we came here to the swing low, we extended it forward, and here we have a touch of the line, and here we have a third touch, and that validates our trend line. Okay, so you're saying, why is that important? Well, if you're following the rules, you're drawing the same trend line that a million other traders are drawing on their charts. And when you do that, you now know what price will be important to those traders. So like we see the euro US dollar is currently trading at 122.319. We have the trend line moving up here. If the price eases down, we're going to hope that the price touches that trend line, which becomes a support line. And we'll talk about support in a minute. And we'll bounce off of it and continue upward. It could violate it and break down. And in that case, it's telling you that trend line is no longer valid, and it might indicate that uptrend is also ending. So we then know that this price, okay, the price along the trend line is significantly important. So when we can see price coming down to touch that price, that trend line, we then can expect what? Some type of action from the market. We don't know whether that's going to be at which direction the action is going to be, but we're expecting some type of action. When we get this action, we then can prepare our reaction. Now, that's just the basic, simplest process. That's not the whole thing of investing your money and losing a ton of money. This is just a start. But now we've tried to find a way to make sense of price movement so that we can then decide when we would want to enter the market or exit the market, or when we want to be alerted to something happening. Now, if we were to take that simple number here, that simple line here, and add to it something simple called volume, volume tells you how much activity is happening, how many contracts are being exchanged, how many buyers and sellers are entering that market. When price is moving along a trend, we would expect, if price continues moving up, that the volume would remain consistent. When we see price retracing like it is right now, we're waiting for the buyers to decide what to do. If they break through, we might see an increased volume in selling. If it bounces off here, we might see an increased volume in buying. Well, if it touches the trend line and we see an increase in buying or an increase in volume, what does that tell you? The buyers are jumping back in the marketplace, because the buyers are always looking for the lowest point that they can enter an asset. So when they see it touch that trend line, they say, okay, I'm going to go back in that marketplace, and they drive the market up. So by combining a trend line with a simple volume indicator, we now have the basis of some type of market understanding, not a trading strategy, not an investing. We're now making some heads and tails of what is happening in this marketplace. And guess what? All this falls under the category of technical analysis. Now, if we simply add on to this, let me just get my marker turned off here. If we simply add on to this one or two other pieces of information, we might be able to tell an entire story about what we can expect from this asset. So let's go back to my PowerPoint. And let's talk about the next step. So once you understand the concept of a trend, the next major concept is that of what's called support and resistance. Now, there's many different types of support and resistance. A trend line is a support line because it supports the price above it. So when price is easing down to that trend line, we're going to expect it at that level to support that price to move back up. Okay. But we also have what's called support and resistance levels. And you'll often hear technical analysts talk about the ongoing battle between the bulls and the bears, or the struggle between buyers and sellers. This is revealed by the price of an asset seldom moves above or below. Now, let's try to explain this to you in an easy manner, because it's an easy concept, but a lot of people get lost on it. Just trying to look. Okay. Hold on a second. Now, so the easiest way I can explain it to you is, let's imagine that you are gold, and I paint you gold. I write across your chest 1250, and I shove you in an elevator. Now you're a bar of gold, so you don't have any hands. You can't push a button. So you just have to go along with where the elevator is moving. So the floor below your feet is what? Is your support. The resistance is the ceiling above your head. In order to move up, you must move past that resistance. But if you jump up in that elevator, up, jump as high as you can, keep hitting that ceiling, every time you fall back down, you're going to fall back to that floor, which is supporting you. Now, eventually, you'll move through that ceiling, and what will happen is that ceiling will become the floor below your feet, or your next support level, and you'll have to go up to that next resistance level. But because you don't know what floors you're on, you don't know where that elevator is going to stop. Okay, and you can't control it because you don't have hands to push a button. You have to do this and figure it out by analysis. So let's say hypothetically that this is a 4-story building. And this 4-story office building, on the ground levels, got a coffee shop. It's got some, women's boutiques. It's got a bakery. It's got a couple little stuff in there, a place to get cigarettes. That's about it. The next 2 floors are very high-end offices, professional offices, doctors, lawyers, dentists, stuff like that, accountants. And then the floor above that is made up of conference rooms and libraries, or whatever, that the office professionals downstairs schedule and use. The floor above that is storage rooms or storage lockers, where they store their back office material and their back, everything they don't want to keep in their office. And the floor above that is a beautiful roof deck with, coffee machines and vending machines and tables and chairs, and a big outside roof deck for smoking. Okay, so this is the same thing as analyzing the markets. Now, if we look at our watch and see it's 8 o'clock in the morning, we can figure out that most people haven't come to work yet. Sorry. So if that elevator starts moving up with you in it, it's most likely going to go to 1 to 2. But if it doesn't stop at 1 or 2, nobody's going to stop at the conference room, the supply room. It's going to go up to the elevator because somebody in the building probably wants to smoke a cigarette. Now, when it comes back down, it's probably going to come all the way down to the ground level, or even may go to the basement, because maybe it's just a janitor who's cleaning the floors. But come 9 o'clock, when people are starting to come to work, remember, you're standing in this elevator, you can't move. And the elevator gets packed full of people and starts moving. Well, the next stop is probably going to be the first floor and then the second floor, because the people are all coming in from the office. Now, they all empty out on the second floor. You're still gold. You're stuck on that elevator. And it goes down to the ground level and fills up with more people again. And everybody gets off on the first and the second floor. But while you're standing there, somebody got on the first floor. And where's that person going? Well, probably not to the conference room. Probably not to the office supply room floors. Probably up to the roof to smoke. That's where it does. Now, we can now establish support and resistance zones in that elevator based on the price of the asset, the time of the day, the events going on, and figure out what the support and resistance level is around the current price. And you can have multiple support and resistance levels. Okay, we can have support and resistance zones. But when we see price on a chart moving above a support level that's been established, we can expect it to stay above and bounce off of it and move up to its next resistance level. There's no law that it can't break through that resistance level, but we would expect it to hit resistance and maybe bounce back down. So this would help us make smart decisions when we would want to enter the market or what we could expect market reaction to be. So if we go back over to our chart on the euro, over here, we can then start finding out what our levels of support and resistance are. Hold on one second, I want to bring something up for you. I'm just trying to bring up another screen. Okay, now, there are many different ways to achieve support and resistance levels. There are eyeballing. Okay, eyeballing is a way of just looking at historic prices and where this price is traded in the past and see how or what price was important to that level and where it had moved before. And we call this eyeballing. There's also a way called pivot points. Pivot points are mathematical calculations that you can get from a pivot point calculator, or you can get them on any technical analysis website like investing.com. They are the same everywhere. They do not change. They're not up to analysis. They're just a set of calculations. So here we're looking at the pivot point calculator for the euro US dollar. And we can see that right here. And we want to make sure it's in the same time frame as our chart, which we're looking at a 1 hour chart. So we want to look at these calculations on an hourly basis. And what it's telling us is the support level currently for the current price on the euro is 122.19. Hold on, let me get my marker off so you can see it through it. So that's support level 1 is 122.19 and resistance level is 122.34. Okay, and then we have the next level out, the next level. So this is like the floors in the elevator and each floor above and below. So we're only going to stay with the floors above and below us now because we don't have that much time. So we're going to go over to the euro US dollar chart. And we're going to draw a line on the chart at each one of these prices. So we have 122.19. I don't know what it's doing. Okay, and then we're going to draw 122.34. Okay, so now we have the levels of support and resistance above and below the current price of the euro US dollar. So what we're doing is we're slowly boxing this in. we're slowly interpreting price movement and figuring out where we can see some action and reaction. Now look at this. We saw in the last few candlesticks, price touched the resistance level, fell back to the support level, came back up to the resistance level, and now we'll probably fall back to that support level. At a given point not far in the future, we're going to have this support and resistance level and this trend line cross, which will give us a very crucial price point. We combine that with volume, we've really told a story of the markets. And what is this? This is technical analysis. Pretty easy stuff. Now, yes, everybody makes it complicated. Everybody wants to make it hard. And it is. You can add all types of tools. You can go over to chart patterns. You can go over to chart patterns are one of the best ways to analyze the market. And that's seeing repetitive patterns in price movement on the charts. Okay. But then you can go, we have people who use all kinds of combinations of this indicator and this oscillator and this to make heads or tails out of the market. But the fact is, every professional trader will tell you that price action is the ultimate controller of the marketplace. And that technical indicators, those are all the fancy things like Bollinger Bands and MACD and RSI and stochastics and CCI and ADX, and the names go on forever, are secondary pieces of information used to confirm a decision you've already made. Or they might give you an alert, but they should not be your primary decision-making tools. Your primary decision-making tools have to involve price on the chart, because the ultimate thing that happens is the price. So what do we've got? We've got trend lines, we've got volume, we've got support and resistance. And we've already started to make some type of, we've started to unravel some of this mystery about the chart and price action. So remember, support and resistance analysis is an important part of trends because it can be used to make decisions and identify when a trend is reversing. For example, if a trader identifies an important level of resistance that has been tested several times and never broken, he or she may decide to take profits as the asset moves towards that point because it's unlikely it will move past this level. So again, if you combine it with volume, volume will tell you what every other trader or what the traders are thinking or doing based on price movement. Now, everybody wants to outguess everybody. But a good trader doesn't want to outguess. You don't want to be smarter than the guy down the street. You don't want to be smarter than the hedge fund guy. You just want to be able to take some profit out of the markets. You don't care if you're following his footsteps. You don't care if he's got, making the big bucks and he's making $1 billion while you're making $100. Okay. You don't care that he gets in the market first. You would like him to get in the market first so that you can see what he's doing. And you can just say, fine, I'll go make my little trade, take a little bit of profit and go home happily. So volume is simply the number of shares or contracts that trade over a given period of time. The higher the volume, the more active an asset. To determine the movement of the volume, charters look at volume bars that can be usually found at the bottom of the chart. Volume is an important aspect to technical analysis because it is used to confirm trends in chart patterns. Any price movement up or down with relatively high volume is seen as stronger, more relevant, more than a similar move with weak volume. Therefore, if you're looking at a large price movement, you should also examine the volume to see if it's telling the same story. Volume should move up with the trend. If prices are moving in an upward trend, volume should be increasing. If the previous relationship between volume and price movement starts to deteriorate, it is a sign of weakness in the trend. For example, if an asset is in an uptrend, but the uptrending days are marked with lower volume, it's a sign that the trend is starting to lose its legs. Now we come to the part of this that everybody wants to trade with, and that's called indicators. And I guarantee you, 90% of you guys out there say, oh, I trade with RSI, I use stochastics, I use MACD. But you couldn't even explain to me what they are, where they come from, and why you use them. Somebody told you, MACD's wonderful, do this, do that, and do this when it happens. Well, not MACD, but indicators, you have to understand, number one, what they are, where they come from, what they do tell you, what they're good for, and have to understand every bit of what their underlying, you have to understand every bit of their calculations, because otherwise you get their nuances totally incorrect. Now, indicators are calculations based on the price and the volume of an asset that measures such things as money flow, trends, volatility, and momentum. Indicators are used, and remember I said this earlier, as a secondary measure to the actual movement and add additional information to the analysis of a security. Indicators are used in two main ways: to confirm price movement and the quality of the chart pattern, and to form buy and sell signals. There are two excuse me. There are two main types of indicators: leading and lagging. A leading indicator precedes price movement, giving them a predictive quality, while a lagging indicator is a confirmation tool because it follows price movement. Now, that doesn't mean that one's better than the other. A leading indicator simply tells you ahead of time that the trend is about to end, or predicts it, but it can't pinpoint it can't pinpoint the end of that trend. I'm sorry, yes, a lagging indicator will tell you right when that trend is ended, because the end has already happened. So it's lagging slightly behind, but it's confirming that that trend is ended or a movement has started underway. A leading indicator precedes price movement, giving them a predicted quality, while a lagging indicator is a confirmation tool. A leading indicator is thought to be the strongest during periods of sideways or non-trending ranges, while the lagging indicators are useful during trending periods. Now, do we just not have leading and lagging? There are also two types of indicator construction. There are those that fall in what's called a bounded range and those that do not. The ones that are bounded within a range are called oscillators. These are the most common type. Oscillators indicators have a range, for example, from 0 to 100. Some are from -1 to +1. Okay. But whenever they're used, whenever they're calculated, they will always come in within that range. So let's go back to my charts here. And let's drop everybody's favorite on here. And we're going to drop on the bottom of our chart, RSI, Relative Strength Index. And so as you can see, let me get rid of MACD here. So as you can see, RSI always comes in between the 100 range and the 0 range. Between 30 and 70, it's actually telling us nothing, this purple zone. So when it's above the 70 range or below the 30 range, is telling us the market is overbought or oversold. So this means it's a leading indicator, because a market that's overbought can remain overbought for quite some time, or a market that's oversold can remain oversold for quite some time. But it's a bounded oscillator because it's bounded between the 0 and 100. Okay, the two main ways that indicators are used to form buy and sell signals in technical analysis is through crossovers and divergences. Crossovers are more popular and are reflected when either the price moves through a moving average or when two different moving averages cross each other. In other words, two simple moving averages put on your chart can cross over each other, and when they cross, they tell you to buy or sell. The second way indicators use is through divergence, which helps when the direction of the price trend and the direction of the indicator trend move in opposite directions. So in other words, if we were to see the prices moving up here, but we see a divergence in the trend line of the indicator, we have a serious divergence here. That is telling us that we probably have an end to this trend, because we have price trending up and prices moving upward, and the indicator should continue to support that. So this is called a divergence, when one moves in one direction while the other moves in an opposite direction. But it doesn't mean to make a trade. Then we also have, let's use MACD here, put it back on my chart. We have indicators like MACD that use a signal line and a MACD line, which are based on moving averages, but a little bit more complex. And when they cross over each other, they generate buy and sell signals. But we can use something even more simplistic, and that's a standard moving average. And there are many different strategies using moving averages and moving average crossovers. Okay, so we just put a moving average on this chart. Let's make it a little bit more visible for you. Let's make it a bright yellow. Let's make it a little wider. And we're going to use we got a 9-day moving average. So when we see the moving average the price cross over the moving average, it also can serve as a signal. And it's a simple technical analysis tool. Now I'm going to get the rest of the stuff off the bottom so we have a better to see visual area. Now, the second way to do this is with a fast and a slow moving average. And say we can use it says they use a 20-day moving or 20-period moving average, and we'll make this green. We'll make it bright blue. And make it. And this yellow is like a hideous color. So let's change this yellow color here. Okay. So when the two moving averages cross over each other, they would be considered generating buy and sell signals. Simple technical analysis. Now, if you understand a moving average, it's easy to figure out. A shorter term moving average. Now, how does a moving average work? It would use, if we're using a 9-period moving average, it would use the close of the last 9 sessions or last 9 periods. So here we're using a 1-hour chart. So it would take the close of this asset at the end of each hour for 9 hours, divide it by 9 and give it the average. Now, if we were using that with a 20-period moving average, the 20-period moving average would use 21 hours. So the 20-hour moving average would be considered the slower moving average. Why? Because it's using a longer period of time. So it is less responsive to the most current price movements, where the shorter moving average is more responsive to the most current price movement. Because when you're only using the last 9, when you're only using the last 9 periods, when you only use the last 9 periods, as opposed to the last 20 periods, it's going to, the calculation is only based on 9, so it's going to be more reactive. So one is considered slower and one is faster. When they cross over each other, they generate buy and sell signals. So when the slower moving average crosses the faster moving average, it generates a sell signal. When the faster moving average crosses the slower moving average, it's considered to issue a buy signal. So now you've got a whole bunches of pieces of information put together that all fall under technical analysis. Not very complicated. You can learn and master these in no time flat. And don't be intimidated by everything. It's not so hard. You can come to grips easily with technical analysis. And if you want to learn more, if you go to cmstrader.com, they have a full array of educational materials. They also have one-on-one support with one-on-one training with a financial manager, and they'll help you understand all of this, and their charts right on their screen and all their indicators are right there, easy for you to use. Now, tonight's class is being recorded. You can access a copy of this recorded version in about 24 hours by using the same link you used for tonight's class, or you can go to investing.com where you're registered for the webinar, go under the education tab, and then go under webinars on demand, and you'll be able to find this webinar once it's put up there. So thank you very much for joining us. Thank you for supporting investing.com, and thank you very much for giving cmstrader.com a try. Good night now.